So she will be presenting a paper called Payments Under the Table, Estimation and Implications for Optimal Tax Policy.
Hi, everyone. My name is Ana Franco. I'm a PhD student at the University of Michigan still. First, thank you for inviting me. Thank you to the organizers for inviting me to the conference. Okay, so today I'm going to talk about payments under the table, which is a form of wage underreporting. And I'm going to focus mainly on the estimation and the implications for optimal tax policy. So let me start with the motivation here. So the standard view in development economics is that income tax evasion is typically associated with informal workers who are not registered in any firm's payroll, and because of that, they are not subject to income taxation, and they also they are not subject to payroll taxation. And on the other side, formal employees are assumed to comply with taxes because there's typically third-party reporting from the side of the firm. The firm is the one many times withholding the taxes, so we assume that they are compliant. However, there's growing empirical evidence showing that formal employees, those who are registered, are receiving part of their wage off the books. This is typically received in cash, typically in an envelope. That's why these are called envelope wages or payments under the table in the literature. I want to emphasize here that these are not informal workers. These are formal workers, registered workers. So this is happening even in the presence of third-party reporting, where the firms are the third-party reporters here. Well, I'm going to talk a little bit more about that, but this has mostly been studied in Latin America and many Eastern European countries. However, despite the growing empirical evidence, we know very little about what this type of wage underreporting, these payments under the table imply for tax policy. And this is potentially interesting and policy relevant because we know that formal workers are not among the lowest part of the income distribution. So the potential implications of this type of behavior are not only going to be for tax revenue, but also for redistribution potentially. So, and this is where I'm going to make the main contribution in this paper. So concretely, I'm going to answer two questions. The first one is how to measure payments under the table. I'm going to propose a new way of doing it. And then I'm going to ask if these payments are prevalent in an economy, how should governments rethink their optimal tax policy? So regarding the first part, I'm going to develop a new matching method using optimal transport, and I will use two data sets that most governments already collect. I'm going to talk more about this, but I will apply this method for the case of Peru, and I will find that around 30% of wages are paid this way under the table, and that this is increasing with education and with income. So this is going to be more prevalent across the high-income individuals. In the second part of the paper, the tax design part, I will split it in two parts. I'll have a theory. I'll have a theory part where I will develop a model of optimal income taxation in an economy where I will allow payments under the table to exist. And then I'll take the predictions from the model, and I will test this using data also from a Peruvian tax reform. So that's basically the setup of the paper. Today, I'm mostly going to talk about the measurement and the empirics part of the paper. Okay, so this paper relates to several strands of the literature, the main two being the intersection of the payments under the table envelope wages literature that has mostly focused on measurement as of now. Most of the researchers have tried to capture this behavior. And there's also a big, as we know, a big literature that studies the optimal income taxation under several different settings. But most of these papers are focused on developed economies where the implicit assumption is that when you have third-party reporting, basically evasion is negligible. So this paper is going to be in the intersection between these two strands of the literature. This paper also relates to the large literature of informality in labor markets, but in this case, the informality is not going to be a binary status. This is going to be more like a continuous status because formal workers can have part of their wages being paid informally. So, okay, so first I'm going to talk about I'm going to talk now about the first part of the paper, how to measure payments under the table. Before getting into the details here, I want to emphasize that payments under the table or in general evasion is very hard to measure. So most of the efforts that researchers have done in the literature to try to capture this behavior are going to be imperfect, but we still need to get a sense of whether this is a real issue in the economy. So with that in mind, let me tell you the existing approaches to capture payments under the table or envelope wages. So mostly the first approach are surveys, just asking workers directly, do you receive payments under the table? And if so, how much? What is the percentage of your wage that is paid this way? And there are several papers here in Latin America and in Eastern Europe, and they consistently find that this is a behavior that exists. Of course, the percentages range across across countries, but we have numbers that go from 5% to 50%, which is consistent with what we saw in the previous paper as well. The challenge with the surveys is that, well, first, surveys are expensive, as we know, but also individuals may be reluctant to disclose directly this type of evasion for a variety of reasons. So another way that the literature has tried to come up to try to infer what is the size of payments on the table or the prevalence is to use responses from reforms. Just find a reform that changes the incentive to report wages but doesn't change the true productivity of the worker. And then if you see a jump in the reported wage, using bunching estimators, typically researchers infer that those are payments under the table because you didn't see a real change in the true wages. The challenge here is that, of course, this requires a specific policy variation, and you lack external validity. So the method that I'm going to propose now is going to alleviate some of these concerns, but it still is going to be an imperfect measure of payments under the table. So what I'm gonna do here is I'm gonna compare two types of wages. One is the wage that is reported by the firm to the tax authorities. That is gonna come from the matched employer-employee administrative data set that is typically collected by both the Department of Labor and the IRS of a country. And then I'm gonna use the self-reported wage by the worker in the labor survey of the country. And the important thing here is that these are two data sets that most governments already collect. So there's no need to actually collect, there's no need for actually collect an additional survey. The setting that I will use is going to be Peru for 2022, and the two data sets that I will use are, as I said, the match employer-employee. This one comes from the Department of Labor. Among other variables, this is going to include the wage that is reported by the firm. This is the third-party reported wage. And the other one is going to be the labor module of the household survey that is collected by the statistics office. And among other characteristics, it includes the self-reported wage by the workers. And both data sets include a variety of characteristics that are common across the two data sets. And I'm going to use those to do the matching, as I will explain now. Why Peru is, so Peru has a very large informal sector, fully informal sector, and there is consistent evidence that most of this informality is not due to low productivity. There are many people who are willing to be in the informal sector, even if the formal sector jobs are available to them. So these same incentives, my guess is that these same incentives could be playing a role in the payments under the table as well. People don't want to be fully formal because they don't value formality. And also there's weak enforcement. Okay, so with that in mind, let me show you some descriptive statistics about these two data sets. So this figure shows the wage distribution of workers with less than secondary education in these two data sets that I mentioned. The one in black is the household survey, so that's the self-reported wage, and the one in orange is the payroll wage. As we see, and the vertical line is the minimum wage. So we see that the two distributions are very much bunched around the minimum wage, which makes sense because these are low-skilled workers. Then if I plot the same figure for workers with secondary education, the payroll administrative data set, this is the match employer-employee, is still bunched around the minimum wage, but the household survey is a little bit more shifted to the right. It's very noticeable, but when I do the same for workers with higher education, I see that the payroll administrative data set is still bunched around the minimum wage, but the household survey, this is what workers report, is even more shifted to the right. So this is just descriptive evidence. This data is not matched at all. This is just the distribution of wages in these two data sets. And it seems like workers are underreporting wages in the administrative data set if we take into account that in Peru, at least, not many people have tertiary education. So there is a premium for having higher education. And what we see here is that in the administrative records, many people with higher education are reporting to be earning the minimum wage. And we know that that is typically not the truth if we go to the survey. So with this in mind, I want you to think about the survey wage as the true wage plus a measurement error that is going to be present in all surveys. And I want you to think about the administrative wage as the true wage minus the payments under the table or the underreporting in the form of wage in the form of payments under the table. If I want to get the true payment under the table for each worker, and if I had the individual IDs and I could match them, we could easily get the predicted payment under the table as the difference across them, plus the measurement error. But for the case of Peru, and I think this is also the case for many countries, the Statistics Office, and in particular the Department of Labor and the IRS, they don't want to share the ID information. So there's no way for me to match individuals directly. So the best that I can do here is to do a statistical matching using the shared characteristics that I have, but I try to do it in a way that will allow me to recover the full distribution of payments under the table, because I wanted to know more than just the mean or the median. I wanted to know how the payments under the table look like across the income distribution to get a sense whether this is a behavior that is more prevalent at the upper part of the income distribution or in the lower part of the income distribution. And I'm not going to get into the details of the matching procedure. It's in the paper. So happy to talk about it over the coffee chat. So the coffee break, sorry. But the basic idea is optimal transport allows you to do a matching using all the common characteristics in a way that you preserve the distribution of the data set that you believe is the true one. So in this case, I'm making the huge assumption that I think the household survey is closer to the two distribution than what the administrative data set is showing me, or the wage distribution in the administrative data set. So using the common characteristics, I basically say for each worker in the administrative data set, go to the household survey, look at the rank of that person given their characteristics, and give me the wage that this person would have had in the survey. I bring back that wage to the administrative data set. So in the end, I only work with the administrative data set using the imputed wage that come from the survey. Okay, again, as I already hinted, of course, there are many assumptions in this procedure, but the most important one is believing that the true distribution is closer to the survey one. And of course, you may be thinking that we know that household surveys or in general surveys have measurement error that is probably not non-classical, but at least we know that in the majority of cases, the household surveys, people tend to underreport their wages instead of overreporting their wages. So if that is true, the wage that I'm transporting or predict or using to impute is going to be a lower bound of their true wage. So in the paper, I do a lot of robustness tests, and it seems like results are robust to different specifications of different measurement errors. Okay, so that is how I am going to estimate these payments. And now let me show you some results. So this figure shows the PUT prevalence, which is basically the ratio of the total payments under the table in economy divided by the total administrative reported wage in the economy by different education levels. So, well, first, the average that I find is at 33% that I mentioned at the beginning. But then when we do it, when I calculate the PUT prevalence by education level, we see that it increases with education. In particular, for individuals with less than secondary or secondary education, the PUT prevalence is around 20%. And then for individuals with bachelor's and master's, it goes all the way to 100% or even higher. Can be higher than 100% because in the denominator, what I have is the administrative reported wage. So if in the denominator I actually had the self-reported wage, this would be like 50%. So that's the first fact. It increases with income. The other one is also a result that I think is very much expected, that smaller firms tend to underreport more. So this is, or well, actually these are workers working in smaller firms. This is consistent with the literature that it is harder to collude because this is basically a collusion between the firm and the worker. It is harder to do it when you have more actors involved. But what I think is interesting is that even for very large firms, there's still a positive PUT prevalence. Okay, so that was the first part of the paper. In the second part, as I said, once you know or once you believe that these payments are prevalent in an economy, that you could actually test using the method that I propose or believe in the service or the policy reforms, then the second part of the paper asks basically how should government rethink their optimal policy? Should they do anything or maybe just stick to what they already had? And for that, let me show you the tax system in Peru very briefly. It's very similar to many countries where you have a personal income tax that is progressive. So it goes from 0 to 30%. Here, the W bar is the minimum wage. So it increases all the way to 18 times the minimum wage. Then there's a payroll tax that is going to fund the social security of the country. So it's going to be pensions, healthcare, and an unemployment insurance. And then there's going to be a corporate income tax on positive profits. And the rate is 29.5%. So if we introduce payments under the table to this tax system, it's easy to see that these payments are not going to be subject to personal income tax or payroll taxation. So that is going to be the quote unquote savings for a worker of doing payments under the table. But also, firms cannot use them to deduct their taxable profits because these are not reported. So if the worker is not reported them, the firm cannot report it as well. Because remember that everything is third-party reported. So it is going to increase the firm's taxable profit. And that in turn is going to increase the profit tax liability of the firm. So you may think, what are the incentives for the firm to engage in this behavior? But I want you to think about these payments under the table as a joint surplus where these two are colluding, firm and the worker, and there only needs to be a positive surplus, and then they are splitting the profits. And actually, if you sum the personal income tax, these are marginal tax rates. The personal income tax plus all the payroll tax rates, the sum is 31.7%, which is larger than the 29.5%, which is the corporate tax, marginal tax rate. So the incentives to engage in this behavior are there even for the lowest income tax bracket where the personal income tax is basically zero. Right? So the higher the personal income tax, the higher the incentives to do this. And the way that I know anecdotally this is what happened, but the way that I'm formalizing this in a model, the way that they're splitting the profits is that the wages that the firm pay under the table are lower than the wages that the firm would have paid that worker if this worker was in the formal sector. So just let me give you, to formalize this, let me give you a brief overview of the model that I have in mind and that I developed in the paper. I'm not going to talk about it today because this is also not a PF class. The model is going to have two policy instruments. I'm going to have personal income tax, which is going to include both the payroll tax and the personal income tax. It's a huge simplification, but it's going to be, everything is going to be there in the personal income tax. And there's also going to be a corporate income tax because, of course, this trade-off is going to be very important. It's going to be the core of what's going on here. Then workers can actually be hired under two different types of contracts. One contract can be the formal one, where all the wage is going to be reported as it is a standard in a formal contract. In the PUT contract, the true wage is going to be different from the reported wage. So there's going to be a difference between both of them, and that part is going to be what is paid under the table, and that part is not going to be subject to income taxation, to the personal income tax. In the case of the formal contract, everything is going to be subject to the personal to the personal income tax. And on the side of the firm, the key point is that payments under the table are not deductible from the taxable profits. So actually hiring a worker under this contract is going to be more expensive than doing it in the formal sector for the firm. And then we'll have an equilibrium, and then the government, an equilibrium that will clear the labor demand and labor supply under both contracts, and then we'll get the two wages with the finding that the wages in the PUT sector need to be lower for it to make sense. And then the government is going to choose the personal income tax that maximizes welfare here, given that there is a corporate tax in this economy. Okay, so the government is going to choose the personal income tax given the corporate tax. And the main result of the model part of the paper is going to be that the corporate income tax is going to lower the incentive to pay under the table. That is, of course, kind of obvious from the disincentive for the firm to pay under the table. But what is going to happen is that as the firms will be less willing to engage in this behavior when the corporate tax is high, that means that when the government increases the income tax, the personal income tax, the response of workers to changes to the income tax is going to be lower when the corporate tax is higher. So in other words, if you are familiar with the term of the elasticity of taxable income, it's going to be a negative function of the corporate tax rate, just because workers cannot easily pass their income to the informal sector if the firm doesn't want to engage in that behavior. And this makes it optimal to have a higher personal income tax compared to the case where you only have like classical or typical evasion that comes only from the side of the worker. Okay, we are now done. Okay, and then the last part of the paper, I think I have 5 minutes. 5, yeah, I was looking at, thank you so much. In the last part of the paper, I'm gonna test this prediction that comes from the theory part. So remember, from the theory part, I basically found that when the corporate tax is higher, then the workers will respond less to the changes in the income tax rate. So here I'm gonna test that using a policy change that happened in Peru across the period of time where I have the data. And it's actually an agricultural regime tax reform as well as the previous paper. Okay, so in Peru, we had an agricultural regime where workers, for workers that were doing work in agricultural firms, but in roles that were in the field. So in some specific regions of the country, if a worker was hired by an agricultural firm, that worker would have a lower personal income tax, and also the firm could have a lower corporate income tax because of that. For workers that were hired in agricultural firms, but who were not in those regions, the standard rates apply. So there was no tax exemption at all for them. Then in 2020, between 2020 and 2023, there was a change in the agricultural regime, and there was no change in the general standard regime. And I'm gonna leverage that policy change that happened across this period of time to see what is the change in the reported income of workers in the agricultural sector. So what I'm gonna use as the treated group are gonna be the agricultural workers in the agricultural firms under this regime, and the control group are gonna be agricultural workers in agricultural firms, but in the regions that are not treated. So everything is gonna be within the agricultural sector. And the changes that we see here is that first there was an increase in the personal income tax between 2020 and 2021, both for small and large firms in the agricultural regime, no change in the general regime. That was the first period. And in the second period, for large firms, the personal income tax increased at the same time that there was an increase in the corporate income tax. The difference is that in the first period, there was no change to the corporate income tax. So I'm gonna have two periods of time. In one, only the personal income tax increased. In the other one, both the personal and the corporate income tax increased. So if we believe the result of the model, we would expect a higher effect in the first period than in the second one in reported income of the workers. And basically, I'm going to do an event study here with these two samples where I'm going to compare the total workers, the first period with the corporate income tax constant. And then in the second period, I'm going to have both of the texts together. So this graph shows the event studies for the first period and for the second period. So this is plotting the effect on the reported income of workers. So in this part of the paper, everything is using just the administrative data set. This is all reported income. I'm not using the service at all. So if you don't trust the matching mechanism, that's fine. Here I'm using administrative data set. And what I see here is that for the treated and for the control workers, before the first change, the first policy reform, there was no change in their reported income. There was no difference or no significant difference in the reported income. After the first policy reform, there is a decrease and persistent decrease in the reported income of workers. In the second period, where both the personal income tax decrease and the personal income tax increase, and the corporate tax increase, I don't see much in the second panel. So this is at least to me, this is telling me that it seems like the mechanism that comes from the model seems to be consistent with what we see in the empirical results. So when only the personal income tax changes, workers are more willing to respond more easily to these changes than when there is a change. When there is a change that is concurrent with the corporate income tax rate, which is consistent with the firm not wanting to engage in these payments under the table as much as when there's no disincentive for the firm. Okay, so that's, okay, I'm gonna need this. Okay, so basically that's an overview of these two parts of the paper. So just to conclude, what I've shown is that first I presented a method to try to capture these payments under the table in a way or using two data sets that most governments already have. So you could easily grab either the survey and the administrative data set and try to estimate the difference across them. And then I basically develop a model to try to understand how the optimal income tax changes when there is presence of payments under the table. And the main result there is that the corporate tax rate is going to play a very important role, in particular by reducing the incentive to pay under the table. Okay, that's it. Thank you.
Thanks, John. A very nice presentation. A quick question about the theory. In the model, do you capture a decentralized bargaining process?
No, it's actually just an equilibrium. It's a market.
Got it. So the reason I'm asking is that because the outside options might matter, and those outside options will determine what kind of contracts we're going to settle on, and as a result, the wage payments. I believe I'm especially interested in that because in the data you have shown us, the people with higher education are more likely to receive PUT, and that perhaps the result of better outside options.
Yeah, for sure. And actually, those higher income people are also probably the ones that can actually bargain better. Because they understand the tax system better, and they understand what the firm is saving by higher
exactly
this contract. No, I totally agree, and that is definitely a next step.
An extension.
Yeah.
I think it's Anders.
Actually, that was my main question, was whether or not within the model you thought of it as a bargaining where the put is essentially the workers take home from that bargaining, and that could give some interesting predictions on bargaining weights that should correlate with the amount. And also thinking of how the reform changes the bargaining weights, I think is super interesting. Like, I don't know much work in optimal taxation that thinks of that. I guess another question is much more nitty gritty is just on the empirics. It's is it kind of fair to say that there's also this assumption that the real W that we're looking for across the two data sets, like how much do we think that we are actually measuring the same wage?
So you mean in the measure?
In the admin, you wrote like the two equations as like they both have the real W, but like how much do we know that the reference period for the household survey is the literal exact same? Or that's not perhaps the interesting comment, but the interesting comment is kind of what kinds of like a little bit like changing those assumptions gives us like a confidence interval for how, what kind of range of estimates should we get and work on that.
So the data that I have in the administrative data set is just what the firm, so the wage for all dependent workers. I've tried to only keep the workers, only keep the main wage of dependent workers in the survey data set, and I've tried to make, yeah, but as I say, I've made a lot of assumptions, and yeah, it'd be great to, yeah, I think it's great to have like a confidence interval.
I had a similar question about whether the bonuses and stuff like that are in there. And have you done your matching just for government workers, for example, or multinational employees or something where we're like, there cannot be any PUT?
There shouldn't be, but I mean, totally, there are, yeah. I can't do it because,
Oh, you don't have the IDs of the firms?
no, I do have the IDs of the firms, but this is the private payroll.
Oh, they don't show up in the Social Security.
But we're doing surveys also to capture payments under the table, like for Latin America, and we are serving workers both in the private and the public sector, and they report receiving payments under the table.
Gotcha.
The government work, which, yeah, it's very hard to rationalize that. Some of them are, I don't know,
Could be
have
citizens,
medical, and sometimes you have some certain caps.
Yeah.
And so if you want the doctor to keep working in your, say, hospital, then you give them additional cash to incentivize them. But yeah, there shouldn't be.
I think you just said you have identifiers of firms. And I'm curious if you can identify particular firms where payments under the table are particularly prevalent, and if there's some hallmarks of those firms that might be lessons for policymakers who are thinking about where to target this enforcement against this particular kind of evasion.
I could do that. I mean, I have the ID, but I don't know. I have ID, but these are anonymized. I don't know which firm these are, but definitely the IRS could, I mean, they know if I identify which one of them have higher payments under the table, the IRS could easily target them. What I can see, and I do, is that this is more prevalent in some industries than others. Like in services, this is much more prevalent than in industries like mining, for example, where it's an industry that is heavily audited and heavily, and it's hard to do it. So. But I could, yeah, you could plan around, you could plan like an audit plan around this. Yeah, that's, yeah, very interesting. Yeah.
So just then you mentioned the differences in sector and the service sector. So another form of payment that would look like a payment under the table, at least in the US, are cash tips. And so in the service sector, it's not the bargain. I mean, it's the bargaining sort of implicit of I'm going to give you a fixed wage and you're going to rely on tips. So it's not quite as much the rigid structure of the bargaining you think of, but that could come into play. So that's an observation. My question would be, somewhere in the background, you must be holding, in theory, you must be kind of holding constant the enforcement mechanism, right? Because these are payments under the table. So this is, you know, if you tried to like say, I'm going to pay 100% of your wages under the table, the likelihood of getting caught goes really high. And if you pay a small fraction under the table, the probability of detection is quite small. So that somehow has to be endogenized at some point. Are you worried about that in the model, or is it buried? You're a Joel Slimrod student, so I know you've thought about that.
Yeah, actually discussed this with Joel. So in this first version of the model, I'm holding that constant. There is a fixed level of enforcement, and basically what is doing all the action in the model is that there is an exogenous cost of cost of informality for each worker. So, and I give that, and the way that I rationalize this cost is just there are some people who value more the benefits of being a formal worker than others. So some people value more having access to healthcare than other individuals. But definitely enforcement is going to interact both with the choice of payments under the table and probably with this cost. I do have a cost. It's not an audit cost or related to enforcement, but of course there is a parameter there that's doing the action here. It's just not enforcement. Regarding to your first question, yes, tips would be in a setting like the U.S. I would be much more worried about the case of tips. In the Peruvian case, and I think it's also the case in many Latin American countries, these workers in the service sector also need to earn the minimum wage that everyone else is making. So tips are gonna be on top of that, and actually tips are not mandatory in some sense like here. So I wouldn't worry much about that. And also in the payroll, I can see, I haven't done this separation, but I can see what part is actually wage and what part is other types of income. So, and I'm only keeping the wage. I'm trying to, but there's definitely here in the US, it would be very different in the type of income.
Thank you. And we started the conversation yesterday just to extend it and to appreciate more after your presentation, of course. To what extent is the paper capturing issues to do, reasons as to why there's an increase to payments under the table? Perhaps it could be weaknesses in tax administration, perhaps it could be trust in government. I just want to see how much you're taking out such attributes to only capture the tax rates part.
Yeah, that is an excellent point. I have no way of disentangling anything of what is going on. I basically, in the case of the reform, I only have a change in the tax rate, and then I see what happens with the reported income. I do have many fixed effects to try to control for different things that are happening at the same time, or different across regions and industries and so on. But I have no way of identifying what it is. And as we spoke yesterday in the service, actually, one of the questions that we have is how much do you trust the government? This question was more for trying to understand what is the motive behind people doing this. And we do find a correlation between people reporting that they don't trust the government, that they think the government is corrupt, and they don't trust the central government or the local government, and engaging in payments under the table. So there is at least like a correlation, but here in this paper, I have no way of separating, but definitely these are very, very good points.